The fundamentals of projects should not be sound when pencils hit papers or CAD pointers hit screens or deals are struck, but rather when formulas and figures are entered into cells. Sounds sexy, right? Good day, everyone. Thank you so much for coming. Today we're going to talk about investment properties and specifically the numbers. If it makes sense in Excel or Google Sheets, then it will be feasible in real life. Now, this video isn't a get-rich-quick scheme or like that. We are actually going to talk about the details around property investment mechanics and modeling them. We're going to run through some of the processes that I follow when I'm investing in real estate, but all of this is going to be discussed in the context of strictly the numbers. We're going to talk about purchase costs, underwriting, operating proformas, and cash flow. Okay, so let's get into it. So we'll open up Excel and I have my property analysis sheet here. So our property, this is unit number 1B, 123 Sesame Street. You can guess where that is. And so we start off first off looking at the purchase price of the unit. So for example, we have $250,000 and then we have a series of additional costs that you have for that unit as well. Now, we have to make sure that we're clear about what all these cells are doing. What I like to do is actually have kind of a formattings to show what a cell is. And so if we go up into the cell styles here, very easy to see that Excel has a whole bunch of presets that are very easy to use and just really good reminders for you to see kind of what your methodology and thinking was for cells. So I can see very quickly that the input cell, so the purchase price here is an input cell. And we can actually see that the PPT cell here is actually a calculation cell. So let's take a look at that. So with that cell, we have a formula here that calculates property transfer tax for us. So in my jurisdiction, property transfer tax is 1% on the first $200,000 of a property and 2% on the remainder. And so I have an if statement that addresses this and helps me to calculate that. And so if I adjust the property purchase price up, it does the calculation for me and I don't have to remember it again. So when purchasing a property, we usually have a bunch of different costs that are involved, and best to either discuss with your lawyer or mortgage broker or realtor around what those may be. So you have, of course, the purchase price, which you negotiate with the seller. You may have to do an appraisal on the property, so having an allowance for that is good. Those appraisals, depending on the degree of due diligence required, could be as little as $500 and could be as much as $5,000. And on commercial properties as well, you could go as high as like $10,000, which I've seen. So something very important to be aware of. Property transfer taxes is something that it varies from jurisdiction to jurisdiction, but you know, the government wants to make sure that you pay your taxes, and transferring a property is one that may trigger that. Legal fees on closing is another thing that you will likely have to incur. Your lawyers or notaries will be registering documents with Land Title Office, and so you have to allow for that, and also preparation of documents and that sort of thing. So having an allocation there. Two other items that people very rarely account for in their proformas are utility adjustments and property tax adjustments. So your property taxes, they are for one fiscal year from January all the way to December, but you actually pay them in July. So you pay them halfway through the year for that entire year. And if you happen to purchase a property partway through the year, and if the taxes haven't been paid yet, there's actually a portion of the taxes that the vendor is responsible for that they should actually be paying for, but you're going to pay them on their behalf. And so your lawyer or your notary will end up doing some calculations around that to ensure that the vendor pays their fair share of the property taxes, and you pay your fair share as well. If the property taxes have already been paid, so if your closing date is actually after when they are due, it makes it a lot easier because they are a known value, and then you're just taking your percentage split of the entire year. So say if you're closing in September, you would pay for 1/4 of the property taxes for that year, and the vendor would pay for 3/4 because September is the 9th month out of the year. There's 12 months in the year, and hey, that's a 75-25% split. So good to go. We may also have capital improvements that you'll want to undertake on the property, and so this is something we're going to get into in another video around doing that analysis and that sort of thing, but it's something you should actually factor into the purchase price of the property. Now the important thing here is that we have a sum formula for the total purchase price, so that's summing up the purchase price plus appraisals and transfer tax and legal fees, so on and so forth. And then I actually also calculate what the net purchase from a lender perspective is. And we'll get into this next around what a lender will do during your underwriting analysis and what they're going to look at and what they're going to quite frankly ignore and assume that you've already taken care of. Okay, so next section is all about underwriting. So we've negotiated a purchase price, and hopefully before you've actually done that, you've gone and talked to a lender or a broker around how much you could potentially spend on a property and how much it's going to cost you and those sorts of things, and tentatively been pre-approved, but you don't have to do this. Nonetheless, even though we're going to have a mortgage broker doing all this work for us, the absolute best thing you could possibly do is completely understand what they're doing and know what you can actually borrow and how much it's going to cost you at the end of the day. So first thing I identify is of my purchase, how much am I going to be paying as a down payment, and that would likely take the form of cash. So I have a calculator here that basically identifies a percentage and then applies that as my down payment. So if I bump that up to 35%, it goes up. If I go down to 25%, it goes down. The reason why I put it at 25% is actually because most lenders are going to require you to put down 25% of the total purchase price of the property. You can go higher ratios, you can go up to 85%. I've actually seen some types of projects, very limited, likely not private market, actually exceed 100% of the purchase price, so they're lending more than the property is actually worth. But in most instances, we're looking at a 25-75 ratio of equity to mortgage value. With this formula, I have actually allowed it so we can have a mortgage, and then I've also allowed for a second mortgage here as well. And under this assumption, we've got 25% down payment, 75% mortgage. You could play with these and actually increase your down payment, but then you'd actually correspondingly have to decrease your mortgage amount. So a good thing to do is actually put a little cross-check formula here. And if we go if open bracket this plus this equals 1, then we're going to say everything is okay, and if not, we're going to say cross-check. And there we go. So we know that it's okay. Now if I put this back down to 25% again, but I haven't adjusted this one here, we have an issue here, and I can put it at 75%. Alternatively, if you really want to make it very, very automated, you could actually equals 1 minus that one there, and it will then always equal 100% financing through this. Now the reason why I left it manual is because we're going to play around with that second mortgage and mezzanine financing a little bit later on. So let's get rid of that formula. Just put this back to 75%, but we'll keep the cross check there to make sure that we have got everything sorted out. But what we'll do is add this one here. So if all three of those equal 100%, which is equal to 1, then it's going to say okay. If not, it's going to give us a cross check. This little idea of having cross checks throughout all of your models, this is why I have been so successful. It's simple math that creates the biggest challenges in performance for projects. I digress. Let's get back into it. $53,000 purchase, but from a lender's perspective, this is only a $50,000 purchase. They really see that the appraisal, the property purchase or property transfer tax, legal fees, all those sort of incidentals that you have, those may not, those aren't really costs that you need to worry about. Now, you can actually ask your broker or your lender to account for those and provide you with additional financing to pay for those, and your corresponding equity contributions may have to be a little bit higher, but in most cases you're usually going to have to flip those out of your own equity. So making sure that you don't just have the minimum 25% for the purchase, but actually 25% plus also your closing costs is very, very important. Next, we have the mortgage calculations, and so we have the mortgage balance here, which basically looks at the actual purchase price from the lender perspective and the ratios, and then calculates what our mortgage amount is going to be. In this case, it'll be $187,500. And then we start to look at the rates and the amortization. So the rate is the percentage rate that you're going to be charged on your mortgage. The amortization is the full duration of the mortgage. And the last term that we have in here, but it isn't really applicable, but we'll talk about later, is the term. And the term is how long you've locked in for those rates and amortizations and respective conditions of the mortgage. And so most commonly you will see a 5-year term for mortgage, and you'll have the respective rates and the amortizations for it and that sort of thing. Conventional mortgage, typically you can have amortizations of up to 35 years, with some less conventional mortgage years you could actually go even longer than that. I'm seeing 40-year and even 50-year mortgages. But for the interest of this proforma, we're just going to use a 25-year conventional. And so the mortgage payments based on that mortgage are $889 per month. Really good thing to do in all of your proformas is to account for whether your calculations are actually on a per month or per year basis. And so let's add that now and just put a little bracket, and we'll put PM, so that's per month. Okay, so we've got that there, and then we have our total debt financing down here. And so what that does is adds up any of the mortgages that we have and then times them by 12 to get to a per year. And we'll add that in as well just for clarifying. Annual. Okay. So with that mortgage there, if we were to drop the mortgage's percentage, increase our equity, our mortgage payment goes down, vice versa. If we were to maybe try to go a high ratio on this, 15% down, 85% lending, mortgage goes up as well, right? So there we go. The last thing I do is actually calculating the down payment needed. Now there's the down payment cash that the lender is using for their analysis, but then there's all the other incidentals that you have as well. And so I like to identify that if I am not going to have my lender assist me in financing the incidentals for the property transaction. So next thing we're going to get into is the operating side of things. We're going to move into our operating, and so we're looking at a couple of things here. We're going to be looking at our revenue for the property, and then expenses for the property as well. So assuming with 123 Sesame Street that it is going to be a residential condo that we're going to rent out, we're going to have revenues coming in. And revenues is actually pretty easy to calculate. You can go and do some analysis and that sort of thing, but ultimately, at the end of the day, you're going to have your rent per month, and then you're probably going to apply a vacancy rate as well. So in this case, we're assuming this is maybe a 1-bedroom and den or 2-bedroom apartment, and it's going to make $1,600 a month. So we'll do 1,600 times 12. You could do a fancy formula here, like if we want to, we could say, let's put a style in and say this is an input, and we can go 1,600, and so you can make it easily adjustable. We can do that times 12, and there you go. And so that you can play around with this, and you can drop your rents down and see what happens, and up your rents and see what happens. And so if you want to do that, that's fine. The other thing that if you're having to show these proformas to your mortgage broker or lender, they're going to want to see vacancy rates as well. Now, vacancy rates are kind of interesting because usually they apply them based on the market. So if you have to go get that appraisal that I talked about before, quite often it'll be making some assumptions around vacancy rates and their valuations. And so you can actually pull projected vacancy rates from the appraisals. Alternatively, there's a lot of reports that are completed either by brokers that are out there or brokerage houses, by the federal government, either through HUD or if you're in Canada through CMHC. They will publish what they're seeing as the vacancy rates for various municipalities or towns or cities or counties or what have you. So with vacancy rates, it's kind of a bit of contingency that they're putting into the proforma, but in reality this isn't representative of what could happen. So vacancy is trying to capture saying, look, if you have a tenant in a unit and for instance they then decide they're going to move, how long is it going to take you to then release that unit based on the either the rates you're going to charge. In an ideal world, you would have a tenant moving out and then the next tenant moving in to start the next month, and so your vacancy rate would essentially be zero. But say you have the unit and you're not able to rent it out and it sits in the market for a month, well then you should actually have a vacancy rate that should be 1 month. So if we do 1 divided by 12, that's actually 8%. Usually, that would be 1 month of vacancy. So that would equal 1 month of vacancy at 8%. But for the most part, you'll see a lot of people make assumptions around vacancy being 1%, 3%, 5%, something like that. But 1 month would actually be 8%. The other thing that vacancy tries to capture is, that rental rate that you have. Maybe you got $1,600 a month from one tenant, but then, the market has shifted a little bit while you were trying to, search for a new tenant, and maybe you're not able to get $1,600 a month again. Maybe you're going to get something a little bit less. So the vacancy rate also helps to capture that. So we'll leave that at 5% right now, and then move on. So a couple of the things that I've made as assumptions. So with Sesame Street, this is a condo, so there's going to be strata fees that'll be paid. These are something you can pull either from due diligence when you are removing subjects on the property, or from the listings as well, as they should be able to post the strata fees. I've assumed in my proforma that I have a management company taking care of the property for me, and so there's a management fee of 25% of gross revenues, so you can see the link there and the formula for it. I've also assumed property taxes as well. Property taxes, you should be able to pull that stuff off of the listing or other online sources, but in reality property taxes are calculated on the value of the property. And so what I've used is actually the mill rates. This is all publicly published documents. You can go to the municipal websites and find out what their mill rates are based on the property designations, whether it be commercial or residential or institutional use and that sort of thing. So for my property, the mill rate is 3.8 for every $1,000. So what I have done is I've assumed that my purchase price is the assessed value for the property, which property taxes are calculated on. You could also probably pull up the assessment for the property and use that for your formula. Then I've applied a mill rate and I've divided that by 1,000, and so there would be my property taxes. Now, property taxes do vary from municipality to municipality. Those mill rates could be as low as $1 for every 1,000, and could be as high as like $7 for every 1,000. So something to really check up on, because this will really impact your proforma. Utilities as well, so annual utilities for the property. I've assumed here that there's some telecom services that I'm going to have to pay for as a landlord, but most of the time your tenants will be paying for cable or internet and that sort of thing. But I've included that at $80 a month. Heat, water, gas, I've included that something in there as well. And sometimes, in order to incentivize tenants, maybe that's something you might want to include in your performance. I actually had a rental property where we had heat, hot water, gas included in the rent amounts, and that was because I was renting to students and they just felt it was so much easier to not have to deal with those sorts of things, and actually helped me to set myself apart from other rental properties. So sometimes really good things to look at. We actually included Wi-Fi internet in the rent for that tenant, and they absolutely loved it. So something to consider. Replacement reserves. So you're going to have some form of upkeep to the property. Quite often you'll probably be trying to capture some of that in your capital improvements before you purchase the property, but there will be ongoing maintenance every year. You may spend this amount of money, you may spend more, you may spend less, but it's always good to have some sort of allocation in there. Replacement reserves on typical mass scale residential properties may be as low as $35 per unit per month and all the way up to $80 per unit per month depending on the property. I've assumed 40 at this point. Last point is insurance, and so in this case this is insurance on the base building, not on any of the contents that any of the tenants may have. They'll have to go get their own insurance, but of course if you can't afford insurance in your proformas, you should not be purchasing property. So then we have our total expenses on an annual basis for the property. So very simply, net operating income, or NOI if you love your acronyms, is the gross revenue, which is our rent less our vacancy minus our expenses equals our net operating income. Some people may want to put their vacancy, because you can see here I have it as a negative number in my revenues, but you could put it as a positive number in your expenses. I would recommend that you actually keep this as part of your revenue calculations, not in your expense calculations. So there we go. Net operating income for the property based on my revenues and expenses is $5,000 per year. And then I've pulled down from up above my debt financing. So if you remember, when we did our mortgage calculations, my mortgage payments were about $1,000 per month. That equated to $12,000 per year. We can see that popping up here. And here is my NOI, or actually we get to profit and loss after debt servicing. And so for this property, if I was to go ahead with this purchase of $250,000, based on my underwriting analysis and putting in $37,000, based on renting it out for $1,600 a month and the various expenses, this looks like I am losing $6,500 per year. So you would ask, why would I proceed with this purchase? And I will tell you that this might actually make some sense. And so let's go through that now. So what I have done is I've actually time scaled our operating proforma. So we can see here we have year 1, year 2, year 3, year 4, year 5. And this corresponds to our rents and all of our expenses. And so maybe let's copy those line items there and we'll paste them there. And we'll make this so it's legible by justifying it like that. Hey, there we go, that looks better. So there we go. Year 1, we basically use the same assumptions that we had in our original proforma. And this would, if you're looking for the lingo, this is your stabilized occupancy. And so we have our rents coming in as we projected, and there's vacancy, and then you have all your fees and that sort of thing, and then you have your expenses, net operating income, and that sort of stuff. The next thing we've done is we're starting to project out every single year. And what's going to happen is every year you're going to increase rents by a percentage basis, and more than likely your expenses are going to go up by a percentage basis as well. And so I have a little table up here that allows for that. So year 1, there is 0 increase, but every year thereafter, we're going to increase our rents by 3.5%. Now, you may need to check with your rental boards around what the maximums are. I know, for instance, where I live, you were allowed 2% flat, which would be lower than this, but a couple of years ago, the maximum allowed increase was up to 4.5%. Something to bear in mind. Maybe you might want to have some conservative projections there based on what your rental control boards will require. Expense increases, this is probably trying to adjust for inflation. So I'm saying 2.5% there. I think this is actually pretty conservative considering inflation, at least where I'm living, has been about 2.25% to 2% per year, but it does depend, in your various districts, municipalities, so on and so forth, around what your inflation is going to be for those respective costs. I know actually, for instance, that insurance costs are going up at a staggering rate. For example, year-over-year insurance has gone up for me 25%. So maybe some of my other items, like my property taxes, have actually gone down, but my insurance premiums have gone up. So being a little bit conservative with this is important. What I would preference, though, is your fundamental principle is that the rent increase will likely be able to outstrip your expense increase. And this is something that is very, very important for us. So, year two, we see that 3.5% increase for our annual rents. And you can see a little bit of formula here. What I've done is I am grabbing the previous number and then applying that 3% to it. Same thing. Next one, same thing with our vacancy. If our rents are going up, then our vacancy projections are going up. So we're still maintaining that 5% vacancy across the board. And then with our expenses, we're doing something very similar. So with our strata fees, we're going up 2.5% per year. And again, we're able to just drag that formula across. So we can see our expenses over time increase as well. But what is happening is that our net operating income is increasing over time. And that's because the revenues are increasing at a greater rate than the expenses are. As I mentioned before, in terms of mortgages, they could be for 5 years. You could actually do a 10-year mortgage if you wanted. Some really savvy people may do a 1-year term mortgage, and they will renew their mortgage every single year or every 2 years. But most commonly, you see it on 5-year renewals. We're going to assume a 5-year renewals there. So actually, our mortgage payments are fixed every single year. There is no change to that. Yet our net operating income, so our profit loss, which started off at $6,000, almost $500 in the hole, slowly decreases every single year. We are actually digging ourselves out of that hole as we go. So that's a good thing. We're still not making money at this point. It's actually costing us, even in year 5, $5,000 to actually own this property. But you can see a trend here. And this is a very good thing. The next reason why I don't think this is necessarily such a bad deal is that with all of the debt servicing we have here and for this mortgage amount is we are actually paying down this mortgage. Over 25 years, this mortgage will be paid off. And so in those mortgage payments of $1,000 a month, there is a component that is paying for interest that goes to the bank and stays with the bank, but then there's a component that's paying for the principal, which is paying down how much you owe the bank. So over the first year, that principal may go from $212,000 to maybe $207,000. And so I have a nifty formula that I've added called mortgage principal paydown. And what this is a cumulative principal formula, and you can look this up. It's in Excel, it's in Google Sheets. Fantastic formula. And what it does is if you input the rates, the number of periods, present value, start period, all the sort of things that you actually have in a mortgage, and you can see I'm pulling that data from up here, it will then calculate how much mortgage I'm actually paying off in that specific year or that specific period. So I've used, you can see here in the periods, start period is period 1, end period is period 12, and that would correspond to the months. So from month 1 to month 12 of this mortgage, this is how much I paid down. And so even though we're at a loss of just shy of $6,500, I've actually paid down $5,700 as well. And each year, because of the way that the mortgages work, your principal payments on your mortgages increase every year and your interest payments decrease every year because you're paying less interest on a smaller balance. And so we can see that every year we're paying a little bit more mortgage off. And it's really amazing to see if you take a look at a full mortgage table, how much a small increase to your mortgage payments in the first 5 years of it make to decrease your mortgage payments over the long term. If you increased your mortgage payments by just $50 a month, in the first 5-year term, that would shave years off your mortgage at the end of the term. So, power of compound interest, greatest force in the universe, said Albert Einstein. So there we go. So mortgage payable principal pay down, that's going to actually shave away at our profit loss here. And then the other thing I want to take into consideration is the property appreciation. So we're going to assume, and this is quite obvious in most markets, is that properties are appreciating as well. And so that property that we bought for $250,000 will or may likely go up in value in the next year. It may go down. There is a chance that it's all dependent on market fluctuations, but in a relatively stable market, it will go up. And I know, for instance, in the market that I'm in, since 1970, the market has gone up on an average of 6% per year. Now, I've actually included in here an appreciation rate of 1%, and so you have to factor in inflation as well. So let's assume that our inflation, it was at 2.5%, and if we're going to include in a property appreciation, that means that the property is going to be appreciating at 3.5% per year. And so in addition to paying down our mortgage principal, our asset is also increasing in value. And so when we actually factor that in, we start to see this property is actually making money day one. So even though we're on a cash flow basis losing money, when we factor in how much of our mortgage gets paid down because of the revenues coming in that are paying for it for us, and then we also factor in the appreciation of the property, we're actually revenue positive on this investment year one. Now, you're not cash flow positive because it's still costing you money, because you can't pull that money out from the bank unless we start to use some of the creative items like our lines of credit up above here. This is starting to look a little bit better of a deal. And as we can see over the years, in year two, it's actually made $2,300. In year three, 28, year 4, 3,500, and year 5, $5,000. Now, it's not to say that you can pull that money out because you've been paying down your mortgage and you've had this appreciation of property. So, but there is some crafty ways to be able to pull that cash out later on. And what I mean by that is I've intentionally shown a 5-year projection here, and that's corresponded to that 5-year term for a mortgage that we talked about. Now, if you were to then renew your mortgage on year 6 and renegotiate that, you could hypothetically have a new appraisal done based on the new value of the property, which in this case would be $12,000 there, plus our $262,000 worth of property value. So you could get an appraisal done to help substantiate that. That would allow you to then get a larger mortgage based on our ratios here. And you could also potentially have some of the money that you've paid down from your principal and refinance it and get that money back. Now, you would be setting yourself back to square one, but hypothetically, you could access some of these funds or a portion of these funds at your refinance. I wouldn't necessarily recommend that you do that, but if you're looking at some sort of exit strategies, something to definitely consider. And so we can see over a 5-year period, based on a $37,000 investment, we are actually technically making $14,000. So that's a pretty reasonable return, and it's actually more fascinating that at face value, based on a $250,000 purchase price, even though it kind of shows that maybe you're losing money year one on it to the tune of $6,500, over the long term you actually are making money potentially on this property as well. So as you can see, there's no fancy tips or tricks here. This is all about pure awesome Excel analysis, metrics and formulas and sweet percentages. This video is actually part of a series I'm doing called By the Numbers, where we're going to cover different aspects of real estate development and developing proformas for modeling different projects and that sort of thing, please feel free to check them out on my channel. Lastly, there is so much to cover on this topic. We went through a lot in this video. There's so much more, and the comment section is a great place to continue that conversation. So I am really looking forward to your comments and discussion around setting up proformas and modeling different financial situations and that sort of stuff. So thank you very much, everyone. Like that smash button, subscribe, comment, and do all those wonderful things, and we will see you in the next video. Bye.